Everybody, welcome back. Super excited about my guest today, Mr. John Hyre, who has come highly recommended from two friends of mine when I said I need some help with real estate, taxes, and entity formation. So they told me contact Mr. John Hyre. So here he is live from Puerto Rico.
Yeah, I live,
Excellent.
I live what I preach. The tax savings I get here. It was funny. I just got off the phone with an MD who does virtual. He runs nurses in pharmacies. He kind of backs up what they do virtually. He just
Hmm.
moved to Puerto Rico, and so he's actually able to practice medicine from a distance. And what's the benefit of doing that from Puerto Rico? I don't pay federal tax. My tax rate here in Puerto Rico is roughly 6% flat.
That's impressive. But do you have to have, but you have to have your clients in the States, is that
That's
correct?
right. That's
Okay,
right. They don't want you competing with the locals. So the client, you have to export the service.
okay. That would kinda be hard for me for somebody to open their mouth and reach over and I work on them and
Yeah, yeah. Maybe when robotics gets advanced enough that you can do that, cybernetically virtually.
Before we get into the questions, I've got a lot of questions written down here. Tell the audience a little briefly, a little bit about you and what you do and how you help people.
Sure, I'm an accountant, lawyer. Let me reverse the order. Let's go in order of excellence. I'm a really, really, really good lawyer. I'm a very good accountant, and I'm a pretty good investor. Most of my investing's in real estate, although I've gotten a lot ever since I moved to Puerto Rico with the networking here, a lot more into some high tech and biotech type stuff. Then practicing tax law for 27 years. My clients are a lot of real estate investors, but also a lot of professional practices, a lot of entrepreneurs. If you've heard of it done, and maybe if you haven't, I've got people doing it. And then I also put out a lot of information content. In fact, I've ramped that up recently where we're training accountants, we're training entrepreneurs. A lot of focus on self-directed accounts. I think the number one way, people are always worried about coming up with deductions. And I'm like, well, if the income's not taxable to begin with, we don't worry about deductions.
Mhm.
So I'm a big, big proponent of not just IRAs, but a lot of other self-directed accounts.
Let me while you're talking about that, let me tell you about a briefly about a conversation I had last night with the dentist and his wife. He was 52, he plays a lot of golf, he wants to cut back to, like, 2 days a week, and he told me the amount he had in his, 401k at his practice, pretty good amount, 7 figures, and I kinda figured it up, and I said, if you open a self-directed account, if you could do all that, basically what you're telling me, you could invest in real estate in that and be done. He was like, "Well, I can do that? How do I do that?" So, it's really I guess maybe because I've been in this space and you've been in this space so long, we, take that for granted, but for people out there maybe listening to this for the first time, that they could actually use retirement accounts to invest in real estate, businesses, other things. Tell them a little bit about that.
But and let me make a point clear that I think to a lot of people's new. If you have a practice and you have employees, you can still have the 401k for that practice be self-directed. In fact, usually we get those custom designed. It's not as simple as a little old solo 401k. You can get it custom designed. It's not as expensive as you think. And normally the way we do it is if you have 100 grand or less in the account, you get to pick mutual funds and such. If you have 100 grand or more, you get to self-direct. So I just want people to understand that self-direction is a lot more broad. A
Mhm.
lot of people don't realize. They think, no, I have to have a Merrill Lynch account for my practice as 401k. Um, IRAs, 401ks. Now I'm going to use the word IRA generically because it's a
Okay.
pain in the butt to keep repeating 15 different types of retirement names. But when I say IRA, unless I get real specific, I really mean all of it. Health savings accounts, 401ks, defined benefit plans, Coverdales, SEPs, you name it.
Okay.
These self-directed accounts can buy almost anything, right? The list of assets they're not allowed to invest in is pretty short. Stuff like insurance contracts, collectibles. Here's a great example. Could I buy an AR-15 in my self-directed IRA? Yeah, yeah. Now you can't use it. There are restrictions on what you can do with those assets. Could you buy a repeating Colt rifle from 1852? No, that's a collectible. See the
Hmm.
difference?
Yeah.
You can do gold up to a point, silver up to a point, certainly real estate.
How
Now
about
there are,
antique cars?
yep, considered a collectible.
Collectible. Okay.
Yeah, same thing with booze. Any kind of booze, that's collectible. Antique rugs, all that kind of stuff. So it's a small list. The rules of who you can do business with, now that's a lot more restrictive,
Mm-hmm.
right? We have what's called a prohibited transaction, which you want to avoid. I mean, the name kind of tells you, hey, that's bad, don't do that. Those are more complex. And so there are certain people, family members, business partners, employees, managers in your business, people who provide services to the accounts. For example, if I do a tax return for your IRA, I'm a disqualified person as to your IRA. And your IRA, for example, would not be allowed to lend me money. And so we have to be careful with those rules. So what's the upside? I mean, the net present value here is stupid. It's insane. I'll give you an example. If you do one flip a year, starting with 100 grand, so you start with 100, you do one flip a year on whatever, it makes you 30%. You do that for 10 years, once a year. Then you invest for 10 years at 12%, which is not that hard to do. So 20 years of investing. If you do that taxable at 35%, you got $1 million at the end of 20 years. If you do that in a Roth, no tax, you got 4 million in the Roth.
Wow.
Same investment. That's the power of compounding. And it's not intuitive to people that the difference is that big. And then think about it. If I have $1 million taxable and it makes money, I got to pay tax on the money. If I got 4 million in the Roth, I'm still tax free. So whatever income it generates is tax free. You can invest in almost anything. And if you don't have the time, I'll give you an example. I used to invest actively in real estate through my 401k, and I prefer 401ks for rental real estate. We can get into why, over IRAs. I'll use an IRA if I have to, but I prefer the 401k. I used to be more hands-on. And what I learned is I could have a practice and an information business, but not a rental business as well. So I'm a lot more passive now in terms of investing, and I had to learn it the hard way. But did pretty good. I mean, we bought some stuff back in, 09, 10, 11 that we're just now getting around to selling out of a 401k. So you can invest in almost anything. PPMs, syndications, crypto, what the underlying business does. It could be almost anything. It could be oil and gas. It could be a startup of any, tech. I mean, there's so much you can do. So what do we tell people? Do what you know. Do what you know. Whatever you happen to be good at, if there's a way to run it through an IRA or a 401k, yeah.
Well, if somebody already has one established, whether they are the practice owner, whether they're an employee somewhere, they have a 401k, and they're like, man, I want to invest in something else besides stock market. Are they able to get a separate one, or do they have to close that one out or transfer it? How does that work?
The classic lawyer answer, it depends, right? Let's start with the base case. You work at a W-2 outfit. You have a 401k with, Apple. They're not going to let you do self-directed. Now, they could, they just don't. Their plan documents don't permit it.
Okay.
Period. So if all you do is work at Apple and make a W-2, you're stuck with their 401k. Now, your IRA can do what it wants, but that's typically a much smaller amount of money because you contribute so much more to 401ks. Now, let's say you start a small side business. The side business can have a 401k, and there are different types of 401ks. The most popular is called a solo K because they're small, cheap, and easy, but they have all the benefits of a normal 401k or almost all the benefits of a normal 401k. So you start a small business. Ideally, that business nets at least, let's just round it, 60 grand a year. And that way you can contribute 60 grand a year to that 401k. Okay. And by the way, if you work for Microsoft and you have your own business and each one has a 401k, could you contribute 60 grand to each 401k for a total of 120 a year? So the key is having a business that generates, and here's the magic lawyer word, compensation. Roughly described compensation is a W-2, which your business can pay you if it's a corporation. If it's not a corporation, C or S corporation, doesn't matter. Either one can pay you a W-2. If you have any other kind of business, you need to have net income from services or selling stuff. And I'm just simplifying some because it's a short call. Right. You don't want the 15-minute code definition that'll make you want to kill yourself and others. But that's a short way to put it. Now, there is a little trick to move money. Let's say you work at Microsoft and you're happily married. This is really important. Happily married. There is a little trick. In 35 out of the 50 states, I can get a court order moving the 401k balance at work to my spouse's self-directed IRA, 401k, whatever. And here's what this is. It's called a qualified domestic relations order. Tax geeks call them quadros. Some of you are familiar with it the hard way. Like if you were in a divorce or a separation, there's a court order that says, hey, guess how much of your 401k is going to your ex-spouse? Have a nice day. So there are three things that can trigger a quadro. People are familiar with the first two, divorce or separation. That's not the approach I recommend. That's a lot more expensive than the alternatives. The third approach, in about 35 states, you can go to the court and ask for a marital reorganization. And the court might say, for example, all right, I'm just going to use arbitrarily husband and wife. Wife has self-directed, she has her own business, husband works W-2. And the court says, all right, we're going to do a court order that the husband's work 401k gets transferred to the wife's self-directed IRA or self-directed 401k, and some of the real estate that they hold jointly is going to go straight over to the husband. Or you can just have it be one way. Now you better be really, really happily married, right? Husband's 401k goes to the spouse's self-directed account, the wife's self-directed account. Can you do that in roughly 35 states? Yeah, that's still percolating. The judges are starting to get used to it. It's run through the family court of your state. So that's one way to bail money out of a corporate plan and get it into something self-directed. So nice little tip for people out there.
There's a lot of physicians that work for hospitals, and then you're getting these dentists out of dental school that go, and it just costs too much money to start a practice. So they join a group, and they're employees. So both of these physicians and dentists are employees. They're getting hammered by taxes, and they've got their company sponsor 401k. And we just keep hearing, hey man, start a side business, start a side gig, do something to where you can mitigate your taxes. So if they're able to do something like that, that side business, side gig, whatever, that could have their own self-directed account. Is that what you're saying?
It could have a self-directed 401k, which is
Okay.
superior to a self-directed IRA, especially if you're investing in real estate. Now, if you don't have the bandwidth for a side business, and bear in mind, the side business could be a micro business. I had two clients in California, husband and wife, making about 500 grand a year each on W-2s. They had large self-directed IRAs. They wanted the 401k benefits, but they said they didn't have time for a side business. And I said, I bet you're wrong. And they said, nah. And I said, yeah. And they said, okay, here's what you got to do. I said, do you have enough junk in the house that you can sell $2,000 worth of junk every year on eBay or whatever the heck the modern equivalent is? It shows you how dated I am, on Craigslist, whatever. And it was funny because the husband said no and the wife said yes. Then he looked at her and went, yes. And so they started selling about $2,000 of stuff online per year. Didn't even set up an entity, didn't need it. Just a separate bank account, a business reported on your 1040, Schedule C, had to show net income. So you didn't take a lot of deductions when you're selling that little. Net income, about $2,000 a year. And I said, set up a 401k, in this case, a solo 401k, which is simpler and cheaper, contribute about $2,000 a year to it. Now you can start rolling other money into it. Now you can start, in their case, since it was IRAs, they didn't have to do the marital reorganization thing. It was a straight roll from a traditional IRA into a traditional solo 401k. And so now they had the benefits of the 401k, a lot more flexibility, the ability to borrow against real estate without penalty, bunch of benefits. Let me give you one other little piece here. Ultimately, especially in an inflationary environment, you want a Roth. What's the problem? You lose the tax deduction. Everybody loves for their practice to make a big contribution to the 401k, maybe a defined benefit plan, maybe both, and get huge. I mean, defined benefit plans, depending on your age, you can put up to 250 a year in those easily. Throw another 50, 60 grand a year in a 401k, 300 grand a year deductible. That's not bad.
Yeah.
Converting it to Roth hurts. Let me give you a trick on how to do that cheaper. Let's say I got 100 grand in a traditional account. So I took the 100 grand traditional, it lowered my practice's income, it made me happy. Normally, if I convert to Roth, if I convert cash or marketable securities, I got to add 100 grand to my 1040. So it's a wash. It makes me unhappy. Well, here's a little trick. If I invest the traditional money into a syndication, I'm going to use the term loosely, a syndication where someone else is the manager.
Mm-hmm.
I have no managerial control. They have huge managerial control. And it's fairly illiquid, which is pretty normal with syndication. I mean, this is essentially private securities, usually real estate ventures, but it could be oil and gas. It could be all sorts of things. Under tax law, because I have lost managerial control of the money, because there's a manager who has complete control over it, and because of the lack of liquidity, those shares are hard to sell at what you paid for them. The day you invest 100 grand into the syndication under tax law, I can get an appraisal done, and the appraisal will say, well, that 100 cash is now worth 40 to 60 grand. Let's go with 60 grand because of lack of liquidity.
Appraisal for what?
You appraise the shares in the company. I just put 100 grand into a real estate syndication. The syndication paperwork says that the general partner has godlike managerial authority, which is pretty normal. I mean, the only way to get rid of those guys is maybe if they die. I'm not even sure that would work. There's maybe like some vampire thing going on. They're very hard to get rid of. Okay. Well, under tax law, when someone else has that kind of managerial power over your asset, the asset is deemed to be worth considerably less. Likewise, those things are structured so that oftentimes it's hard to sell. You might need a vote. You might need, there might be a right of first refusal, which keeps anyone from making an offer. And just in general, people are reluctant to buy this obscure, non-tradable, illiquid asset.
Right.
Well, under tax law, that makes the asset worth less. So I'm going to say you put 100 into an asset. Now, the key is this. You convert the day after or shortly after, because the longer you wait, as the asset appreciates, if the investment does well, and you get closer to a liquidity event, the more it's worth. The object is to convert when the asset is worth the least under tax law. So the day after I put 100 grand into a syndication, I can oftentimes get a light appraisal, like a BPO, not a super expensive complete appraisal. Mm-hmm. I can get a light appraisal to say, well, that 100 grand that you just put into this asset, you couldn't sell this asset today for more than 60 grand. Then I convert to Roth. So think of the math. I put 100 grand in traditional. I got 100 deduction. I convert to Roth, but I only report 60 of income on the conversion. I have full Roth benefit. This thing's going to grow. Hopefully I invested well and it goes at least to 100, but let's say preferably, let's say 150. It's all Roth. But I only paid 60 grand in taxes, took 100 in deductions. I got a 40% discount. And that is it blew me away on one of my webinars. I do 2 times a month webinars on these kinds of things. Mm-hmm. And I thought this was a simple topic, but I figured, I'll cover this because I think it should be covered. Maybe somebody doesn't know. It turned out nobody knew. I got a barrage of calls like, can you send us to an appraiser? Can you talk to our appraiser? Can you talk to our IRA custodian or 401k company and explain how this is kosher, which was actually quite easy to do. I did get a number of those calls. That's the way to play the game. The only time I wouldn't do that is if I'm going to actively invest at a very high rate of return. So for example, my full-time real estate investors who are going to start flipping properties inside their IRA or 401k, we're going to go straight Roth. They're not going to invest in a syndication, and their income's going to come so quickly from the flips that the discount's just not worth it. Being Roth and paying the full freight for Roth on day one for those guys makes more sense than a passive investment you sit on. So just different circumstances. But for your professionals who invest passively, including me, that conversion route has saved me a ton of money. I get some traditional benefit and 100% Roth benefit. So a little bit of the best of both worlds. That right there is worth the cost of admission.
So people right now that have just IRAs and they want to invest in, they want to take some of that money and they want to invest in syndications or something. They want a self-directed account. You had mentioned it would be more beneficial for them to open a self-directed 401k versus an IRA, correct? Why is
Generally, yeah.
that? And why do you recommend that?
So in particular with real estate, let me give you the two big benefits of a 401k. There are about 6 or 7, but we only have so much time. Prohibited transactions, the object's to avoid them. But if you accidentally have one, in a 401k, the penalty is generally a lot smaller.
Okay.
IRAs, for whatever reason, on prohibited transactions are penalized much more harshly.
Don't they lock you down with that? Like they get rid of it?
Yeah, the IRA dies and all the money gets distributed, which is pretty
Okay.
harsh.
Yeah.
Which I'll give you an example. My IRA has $1 million. I lend my mother $1. The IRA dies. All million is distributed, taxed, and penalized. 401k, if I lend my mother $1, the penalty is 15% of the dollar. Okay, 15 cents a year. Big difference.
Yeah.
Second reason, and this relates to real estate investments, when your retirement account borrows money, either directly or indirectly. And what I mean by indirectly is if you invest in a syndication, syndications are the opposite of Las Vegas. What happens in the syndication does not stay in the syndication. It happens in your IRA. It happens in your 401k. So if the syndication borrows to buy real estate, it's as if your IRA or 401k borrowed to buy real estate. Well, that gives rise to a tax called UBIT, unrelated business income tax. And it's a high rate, 37% in some cases. So 401ks, for whatever reason, Congress treats them differently than IRAs. If an IRA borrows on real estate and there's, let's say, a big sale of the real estate, you pay UBIT. If a 401k borrows to buy real estate, whether it buys it directly, it goes and buys a little house, or it invests in a syndication that buys apartment buildings and borrows, sell the apartment building, normally the 401k does not pay UBIT on the sale of real estate that is leveraged. That's a big deal because a big chunk of the syndications out there are buy and hold for at least 3 to 5 years real estate that's leveraged and is going to be sold at some point. So the fact that you're not paying UBIT, that's a big deal.
If you have right now, like me, a self-directed IRA with syndications ongoing, number one, is there a way to transfer that over to a self-directed 401k? And number two, if so, do I need to wait until the deal or deals go full cycle, or how does that work?
So if you have a traditional IRA, we can roll the traditional IRA, whether it's cash or an asset. Well, ownership in a syndication is an asset. Can I move the asset from a traditional IRA to a traditional 401k? Now, we have to do an evaluation of what stage of the investment are you at.
Well, if my self-directed IRA has a syndication in it, let's say the syndication is like a 5-year hold, and I'm only into year like 2. Is there a way that I could convert that self-directed IRA at some point to a self-directed 401k, thus avoiding the UBIT tax?
You can do it immediately. It's child's play. Now, here's the bad news. If you have a Roth IRA, the law does not allow Roth IRAs to transfer to any account except another Roth IRA. So I cannot move Roth IRA assets to a 401k. Okay. There is legislation that was bipartisan until one party, I won't name, got real partisan. And what was a bipartisan bill, a really good bill, basically Secure Act 2.0, among other things, that has a lot of good stuff for self-directed accounts in it. One of them is you would be allowed to transfer Roth IRA assets to a Roth 401k. So it would equalize things. That's a great thing. And there's other good stuff in there. It was super bipartisan until it wasn't. Now, we're hoping that after the midterms, we pick up some momentum and maybe that bill passes, allowing people then to transfer Roth IRA balances in the Roth 401ks, which I would do. Because again, the 401k is, whether it's traditional or Roth, is almost always, there are some exceptions, but almost always the superior account.
do you work with groups or have any recommendations for if they want to go to look at self-directed accounts? Anybody come to mind? Or
I won't name custodians publicly. And the reason is I work with so many.
okay, but if we were to invest in your services or whatever, we could have access to that.
Oh, my first duty is to my clients. And so
Okay.
privately, I'll tell clients which custodian is best for them.
Mhm.
I have a lot of referrals. I mean, what I do a lot of plan. Here's what I'm good at. I'm really good at you give me all your stuff, your QuickBooks, your entity structure, your tax returns, your personal narrative, your vision, your retirement account balances, all that data. And then I go through it and set up a plan. Now, do I execute the plan? Only certain exotic portions that others cannot or will not do. Most of it gets farmed out. Like I don't set up IRAs or 401ks. I could,
Yeah.
but it's profitable. There are people who do it cheaper and faster than I do. I send you to them.
So if Dr. Smith comes to you, he's got a retirement accounts at his medical practice. He's dabbled into some syndications. He's got some crypto. He's got some stuff that his in-laws have given him, whatever, all over the place. They bring it to you. You get everything structured together, handled right, clean up the QuickBooks or recommendations. And then when you said you farm them out, you have specific people that you work with that said, hey, I work with these people, but I think these two would be the best ones for you.
Yeah. I might send you this outfit for an IRA, this outfit for a 401k. For entities, sometimes I do them, and sometimes I'll send you to someone if I think they're going to be as good as me, but cheaper.
And how about
Etc.
accounting? How about just, accounting for that?
Bookkeeping, I
Bookkeeping.
can find bookkeepers. I'll tell you what's hard right now to find CPAs, that the tax return, good, competent tax return people. I think like some of the medical industry, the tax return preparation industry is actually contracting. I think a lot of people are getting out for a lot of similar reasons, just unpleasantness, not wanting to hire people. Especially the last 3 years, the IRS, because of their incompetence and how they've dealt with COVID, or more to the point, haven't dealt with COVID, have made CPAs' lives a lot more stressful. So finding good CPAs to send you to do your tax return prep is the hardest thing for me to refer people to. They have to be good enough I like them. So some of the ones that need work, I don't want to send work. And a lot of the ones that deserve work don't need work. And so the ones I look for are the good CPAs who are terrible marketers.
And which is most of them.
Well, but it's finding the good ones.
Yeah.
But the stereotype CPAs are not known for scintillating personality.
Right.
And I'm sure there are exceptions, and like to any generalization, but generalizations exist for a reason.
That's right. So yeah, that's very helpful, because I'm always having people that come to me and they're saying, well, I've invested in syndications, and should I hold it in an LLC, and I do this and this, and they're kind of like all over the place. So now it's good to be able to send them to somebody for that plan, get the structure going, and then that's great that you can outsource them. So is
And
this
just
part of your webinar series and things that you do?
that's so I do too. So the webinar series, the way that works is once a month I pick a topic, and half the topics will bore you to tears. And in fact, a lot of the times I know the topic ahead of time, but I don't know the outcome of the topic. I'm monetizing my research. Unlike a lot of tax people, I do a ton of research. Like right now, I'm researching, of all the exciting things in the world, trust accounting rules, because a lot of people are sold into bogus trusts. Let's just say bogus, maybe fraudulent trusts being sold and marketed to people that, hey, if you structure through this trust your business, you don't ever pay tax, and we're going to put your house in it and your business in it. And there are a lot of legitimate trusts, there are a lot of legitimate uses, but there's also a lot of garbage out there. For example, if someone sells you something called a constitutional trust, common law trust, or pure trust, just run away screaming. That's such a signal. It's such a dead giveaway. You get into some that are reasonably aggressive. I'm aggressive by nature on taxes. Here's what I mean by that. Black and white, we follow the law, even if we don't like it. It is what it is. Gray, which a lot of it is, we do what we want. We interpret it in the client's favor. With the trusts, it's the judgment call. Who's selling something that's good gray versus so close to the black that, no, we're just not going to do that. The first webinar of the month, I pick a topic. And about 3 of the year are huge home runs, like that discounting one I talked to you about, how to convert at a discount. About 6 of them, they're okay. And 3 of them are just such horrible duds. It's like, look, I had to research the topic. I just had a dud. I researched what was it? Reducing inflation, whatever. Yeah, haha, good name. You know, I could call my dog a tiger. It doesn't mean she's a tiger.
Hmm.
But I researched the Inflation Reduction Act. Oh, it was horrible reading. And I came up with a few things, but it was little bitty diamonds and a whole lot of coal. But you don't know until you look. So that's the first call of the month. The second call of the month is pure Q&A. We answer about 90% of the questions that come in. Now, some people send me a 50-page book and want me to go through their whole, basically do their planning on a call. That's not going to happen.
Right.
So the planning that I talked about, that's through me. I mean, I only have 2 employees, so we're a small shop and I like it that way. So what's my issue? I mean, other than my awful attitude and directness and bluntness and right-wing politics that I'm very open about and not woke and not sensitive and not willing to change my vocabulary or behavior to please those people. Other than that, I'm busy. I'm a pain. I mean, the nice thing with planning is it doesn't have to happen tomorrow. You can set a call a month ahead of time. And as long as you don't have any pending issues, it's the guys that call me with, yeah, I'm going to sell my practice in a week. What'll I do? Hope to hell you get lucky because a week ain't much time for me to do anything.
Right.
So that's dealing with us. It's, I try to tell the good and the bad, just to be honest with people. So we focus on planning that and fighting the IRS. If you ever get audited, and especially if the audit goes bad, I go to tax court a couple times a year. I love going to tax court and fighting the IRS there. In 27 years, I've never lost.
Impressive.
So, they settle. So here's the secret about tax court. There are way more tax court cases than there are IRS lawyers. So if you have an audit that goes bad, and you sue the IRS, which majority of the time tax court is the taxpayer suing the IRS, odds are about 95% you're going to settle. It's kind of like the old joke with you don't have to outrun the bear, you just have to outrun one hiker. Same thing. I've gotten people things they truly do not deserve by going to tax court because the IRS does not have the bandwidth to litigate things they could win. And so they will settle in order to, and we don't cheat, we don't lie.
Right.
We just bargain hard in terms of we're not that 5%.
Mm-hmm.
You want to give us something to not go to court. So we do some of that. And what I like about that too is it helps me with planning, talking to those IRS lawyers, negotiating with them, figuring out what they like and don't like and how hard they're willing to push. That's extremely informative.
I bet. So if people want to learn about that, some of the information products you sell, your services, how do they get a hold of you or find out?
Taxreductionlawyer.com, taxreductionlawyer.com, or taxreductionclass.com, taxreductionclass.com. Anytime there's a doubt, just Google my surname because it's unique, Hyre, and tax. So Hyre space tax and stuff will come up because we are working on some new websites.
Well, I will put those links below our video, our YouTube video. So I'll make it easy. So if you guys are interested in John or his materials or services, simply do that, and that will take you straight there. John, I really appreciate your time, your wealth of knowledge. I definitely want to get you back because we didn't even talk about opportunity zones, and that's a lot of the things that are going around right now. So maybe we can talk about that next time.
Sounds good to me.